next thing I will explain now is, I think, the most simplest and also most important financial statement, the balance sheet. In order to talk about the balance sheet, we need to discuss a few, it's like learning vocabulary, new vocabulary. First thing I want to point out about a balance sheet, the assets. Assets make up the left side of a balance sheet. So everything you find here is an asset. What is an asset? What is the definition of an asset? Well, in colloquial language, I would say an asset is, or assets, is all the stuff a company owns. That are machines, cash, land, building. So really everything a company owns, everything the company purchases and uses in order to operate, in order to do their business, is what we in finance call assets. In the group of assets, you can distinguish between current assets and non-current assets. There is a very important distinction. In the later lectures you will see, if you start analyzing financial statements, you have to be very, very good at determining is something current or non-current. Current means the asset will be transformed into cash within 1 year or less. So, for example, cash is already cash. That doesn't need to be converted into cash. So cash is the most current asset you can have. A machine typically would not be considered current if, I don't know, whatever company you want to pick, some robot, for example, constructing engines in the company Ford, the car producer. This is used for the production. This will not be converted into cash within 1 year. So, for example, in my example, machines would be therefore a non-current asset. Something that stays in the company for obviously more than a year. The same goes, of course, for land and buildings. You have land because you have maybe your factory there, your company headquarters. That is not, the intention of the company usually is not to transform that into cash, but to use it for the production. Building, of course, the same I mentioned now about land goes, of course, for buildings as well. Usually you have the building because you use it as a factory or because you use it as a company headquarters. So therefore also non-current. But you could also say, if you are a company where the operating business is selling land, then the building would be, of course, inventory. It's also important. Inventory, all the goods a company produces with the intention of selling that. So if you take Albert Heijn, for example, huge Dutch supermarket chain, all the stuff you see in the shelves would be considered the inventory of Albert Heijn. The intention of holding that inventory is, of course, to sell it to customers. When you want to answer the question, is that current or non-current? It's very simple. The intention of Albert Heijn, the reason why they have, let's say, hundreds of liters of milk in their shelves is not because they need a lot of milk, but because they want to sell it. So here it's very clear, the intention is to transform it into cash as soon as possible, therefore current asset. The asset side. It's just a quick overview. We move to the right side. On the right side of the balance sheet you find liabilities and owner's equity. Of course I will explain what that is. Let's talk first about liabilities. Liabilities, the position liabilities is basically the money that you owe to other people. Usually you would expect to find in the liabilities bank loans and payables. I think it's obvious what a bank loan is. Everybody knows this from his or her own experience. If you go to a bank, ask for a loan for your house, you have to repay the nominal value, including interests, of course. The same goes for companies. If they get a loan, they have to repay that. That is money that they owe to a bank. Liability has to be repaid. Payables, very important position. That is money that you typically owe to your suppliers. If I'm a company producing cars, for example, I might not construct the engines myself. I can already buy readily manufactured engines from some supplier. Of course, I have to pay my supplier. That would be in the position payables. Yeah. Also within the position liabilities, you also distinguish between current and non-current liabilities. When you talk about a bank loan, it can be both. You can have a short-term loan that you repay in 1 year or less. Then it would be a current liability. If it is a long-term loan, let's say 10 years for purchase of a new factory, of course, it would be a non-current liability. Payables, usually, if not specified differently, then payables are non-current. Of course, your suppliers, from the point of view of your suppliers, you are their customer, so they expect you to pay as soon as possible. I think it is safe to say they expect you to pay in 1 year or less. So, current. Now, very important position, equity. Equity is basically the money that belongs to the company themselves. Yeah. Depends on the legal form of the company, in what form the equity, in what form you find the equity within the company. If we talk about corporations, the equity is divided into stocks. So you have in the position equity the stocks, we call it common stocks. Common stocks. Same, the word stocks is the same as the word shares. Yeah, so common stocks. How does that work? A company basically prints out the certificates of ownership and sells it to investors that might have an interest of, well, owning a part of the company. If you decide to buy the stock or the share of a company, you become, of course, a stockholder. That means you own a small percentage of the company. Of course, if you own more than 50%, let's say 51%, that means you have the stock majority, so you own more than 50% of the company, and that means basically you can decide what's going on in the company, you are calling the shots there. Another important, there are basically a lot of different positions. I will not go into the details, that would take us probably too far. Second position within the equity, I have to mention the retained earnings. Retained earnings is basically the profit that is created by the operating business of the company, is calculated in the income statement, which we will discuss in a matter of minutes. At the end of your income statement, you calculate your profit or your loss, and this goes into the position retained earnings. So here you would find all the profits from the future that haven't been used for paying dividends, for example, or for financing some expansion. Yeah? That is the equity. Very important distinction here is a legal distinction. A loan is money, or in general a liability is money that you are supposed to pay back. The loan from a bank. Perfect example, you pay that back, usually including interest. There is a legal obligation for you to pay that back. Equity is different. Equity is money that belongs to the company. There is no legal obligation to pay that back. But since shareholders, everybody who buys a common stock of your company becomes a shareholder, those people, the shareholders, are entitled to several things. Two things I want to point out now. First, they have a right to receive a part of the profits, since they are, well, owning part of the company. This is what we would call dividends. If you, as a shareholder, get part of the profit, you would say, I receive dividends. And the second thing is the voting right. Since you are an owner of the company, it means you have some saying about the future developments in the company. So important decisions will be, of course, discussed with all the shareholders in the so-called annual shareholder meeting. Everybody who has one share is allowed to vote. Yeah? And of course, what is done? Well, what the majority wants. That's why I said before, if you own 51% or more, it's nice because you are calling the shots there. That is, in a nutshell, the balance sheet. Last thing to point out, if you calculate the total of all your assets and the total of all your liabilities and your owner's equity, we call it the balance sheet total, it has to be equal for a very simple reason. That is all the stuff the company owns, and that is where the money comes from. The money used for purchasing those stuff can either come from, well, debt, going to your bank asking for a loan, or from issuing equity, or from profits of the past. So everything you purchase, you have to finance somehow. That's why both sides always have to match. There is no exception to this rule. The balance sheet total of the asset side always has to match the balance sheet total of the liabilities and owner's equity side. If not, if you find here a difference, you know that one of two things is happening. Either some sort of fraud, in my opinion that would be the exception here, or probably more likely some sort of, well, accounting mistake. And that basically is what we discuss next, what I will tell you next, the so-called accounting equation. It's already something I actually mentioned. If you look here, this is the asset side, this the liabilities, the owner's equity. I just mentioned the balance sheet totals have to be the same. So we can already say assets equals liabilities plus owner's equity. This side has to be equally large as this side. Yeah? And with all consequences. If I want to figure out the equity, yeah, how can I calculate it? Assets minus liability. Yeah? Assets minus liabilities equals equity. Yeah? And of course, if you want to figure out, if you know the assets and if you know the equity, and you want to figure out that, also possible, assets minus equity, of course, equals the liabilities then. Yeah? Very important, we call it the accounting equation. This is a relationship that always has to hold true. If not, then there is some mistake here. Yeah? Basically, again, what is the accounting equation? This assets equals liabilities plus owner's equity. Yeah? And all the variations of that. Assets minus liabilities equals equity. Assets minus equity equals liabilities.